Oh, hey, you're back. All right. Never a doubt. Yeah, always knew you were coming back. Okay, part two. Here we go. Now, when people ask me what I do for a living, I say I trade stocks or I'm a trader. Now, here's the thing. While not all of us do trade stocks, we are all, without exception, traders, just by buying and selling stuff on a daily basis. Remember when I said I was previously unaware of what the stock ticker numbers meant, like on the bottom of the screen, like you'd see on CNBC, for instance? Well, it's quite simple. One person wants to buy a stock. Basically, they're representing demand. Another person wants to sell the stock. Well, they're representing supply in this case. And then a trade is made at a price that they agree upon. It's really as simple as that. Now, for instance, if you're looking at the stock ticker, Apple, the maker of iPhones, has a ticker symbol of AAPL. That $139.15 is the most recent trade, and the green up arrow means that the price is 47 cents higher than the previous trading day's closing price. Now, people on TV will say a stock went up or down because of earnings or a million other reasons. Heck, even a presidential tweet at this point. But at a most basic level, it's always the same reason: supply and demand. Of course, this is true for every economic transaction, not just a stock. As the great Richard J. Maybury once said, a price is not a statistic, it's an event. Two humans have made a trade, and the exchange rate in that trade is the price. Well, I would also add that this event is a contract. You hold up your end of the bargain, and I'll hold up mine. Now, while most trades do not involve a literal contract, even an immediate cash transaction carries the assumption that both parties will peacefully go their separate ways, and that all goods and cash exchanged are legitimate. These fundamental decisions made by human beings, each in his or her self-interest, is the foundation of all economic activity. In modern times, money is usually used to facilitate the trade instead of directly trading goods, such as trading a loaf of bread for a gallon of milk. Now, once again, a price is not a statistic, it's an event. But prices are also signals. They inform other interested players in the market. For instance, take the app and the ride-sharing company Uber. Now, for those of you unfamiliar with this company, basically instead of hailing a taxi on the street or via a phone call, you hail an Uber car via a smartphone application. Drivers can be on duty at their convenience via the same application and are free to search for potential rides anywhere they think they can possibly find them. One of the best parts about Uber is that it's an easy, sober chauffeur. Now, God knows I need one every once in a while. But if you've hailed an Uber car at closing time, when many others are likely to be doing the same thing, there's a good chance you're going to see a surge notice. Now, when you see rates 5 times what you expected, it's impossible not to be a little disappointed. I've been there, trust me. But don't be so quick to demonize surge pricing because it works exactly as intended. You see, when surge pricing happens, there are simply more people wanting rides, demand, than there are drivers available, the supply. In reality, surge pricing is a temporary phenomenon. You see, seeing prices that are 5 times what they would normally get, drivers with vacancy, as well as previously off-duty drivers, will flock to the surge area. Eventually, supply meets demand and the surge lowers before eventually going back to the normal rate. There's a reason it's called the law of supply and demand. It's as inescapable as the law of gravity. For instance, what if surge pricing, essentially allowing supply to meet demand, was not part of Uber's policy? The shortage of drivers would surely continue for at least a much longer period of time than it would with surge pricing. The option to pay a higher price and thus leave immediately would not be available to those willing to pay extra and essentially exercise their own time preference. I'm failing to see who wins in that scenario. Okay, I think that's a good place to stop and also transition into our next topic. Why do we trade?